Hi guys, please like, share and subscribe. And if you want full course for any actuarial subject, visit theactuarialguy.com or WhatsApp on this number. Thank you.
Why does insurance even exist? As actuaries, we live and breathe insurance. But have you ever wondered what is its utility in the society? In this video, I explore this question and try to answer this through a very simple example. I'd like to talk about the concept of insurance and its social utility. That is, why does insurance even exist in a society? And what utility do people derive from buying insurance? Okay, there is more on this under subject CM2, where a utilitarian approach to insurance is taken, and there is the whole dynamics of risk aversion, that human beings are generally assumed to be risk averse, and any risk averse person wants to avoid risk, and they prefer certainty, and that's why they buy insurance. Okay, that's the whole utilitarian perspective, which you will go and see in subject CM2. Okay, but from a very general CM1 perspective, I can give you a very simple example which will make it very clear why does insurance exist and what is the role of a modern insurance company, how did insurance first emerge, and then what role does an insurance company play. Okay, so let's just take an example. Let's just assume there is a village. Okay, and let's say in this village there are 10 farmers. Okay, and each of these farmers grows, let's say, any crop. Let's say they grow any crop, let's say wheat or rice or whatever. Let's say they grow wheat, and each farmers produce, let's draw 10 farmers. Okay, so let's not get into drawing, let's just write 1 2 3 4 5 6 7 8 9 and 10. Okay, these are 10 farmers, and let's say their produce for each of them is 100 pounds. Okay, so this is their income as well for all of them. For all of them it's 100. Okay, now there is a risk event that the farmers face. There's a possible risk that there will be a crop failure. Okay, and this crop failure may be due to any reason. Maybe let's say it's because of grazing animals. They come into the fields of these farmers, and in any year grazing animals eat the produce of 2 out of 10 farmers. Okay, every year 2 out of 10 farmers, they lose their crop completely because grazing animals, maybe cows, maybe sheep, anything, any wild animal, a wild grazing animal comes in and they eat all the produce of the farmer, and those farmers are ruined. That is, their complete livelihood depends on this income, and they have no income, and they face a lot of problem because these are not particularly saving kind of farmers. They produce every year and they consume every year. Okay, so if any one of them is affected, they lose all of their crop, and every year this is going to happen 2 out of 10 farmers, for 2 out of 10 farmers, right? You don't know which 2 it will be, they don't know which 2 it will be, but it will be exactly 2, and whoever is affected will be ruined completely, and there is no way they can prevent these animal attacks. Let's just assume there is no way, there's nothing that they can do in order to prevent these attacks. Okay, so in any year, the income of these farmers will look somewhat like this. So for 8 of them, it will be 100. Okay, so for any 8, it will be 100, and for any 2, it will be 0, and these guys will be ruined. And they face this problem every year. Now let's say together they set up a village council, they talk to each other, and they decide that in any year, if some farmer loses their crop completely to these grazing animals, everyone else will contribute to compensate those farmers. Okay, and let's say they decide that they will contribute in such a way that all of their income becomes equal. Okay, so basically what these farmers will do, that these 8 will each contribute 20 pounds. Each of these guys will contribute 20 pounds. The farmers who are not affected by the grazing of animals, and their crop is not lost, and basically when the 8 of them contribute 20 pounds, this becomes 160 pounds, and the remaining ones which have lost their crops will get 80 pounds each. So their final income just becomes, for all of these guys it's 80, because that's 100 minus 20, and for these last 2, since they are compensated, it's 80. Now in any year, no matter which farmer is affected by this grazing of animals, no matter which one it is, all of them are going to have this equal certain income of 80. Right? They have a guaranteed income of 80 pounds. Okay, there is no risk anymore. Their income for some of them might be reduced in any given year, but overall they have a certainty of 80 pounds, and they have they pay out this 20 pounds every year if they are not affected, and they receive 80 if they are affected. This is a basic form of insurance. This is sort of crowdfunding, where they are developing a community based pool of funds and providing protection to their community members. This is a cooperative in its true sense, but it's a form of insurance as well, because it provides certainty. And this is the primitive form of insurance. So here the farmers have been able to easily do 2 things. One thing is that they have been able to eliminate risk, and once the risk of the grazing has been eliminated completely, they can stop worrying about it and focus on what they know the best, that is farming, and probably even improve their productivity and overall increase their produce. The second thing they have been able to do is that they have been able to divide their risk over a large number of people, and this is what modern insurance companies also do. They take risks and they divide it over a large number of individuals or a large number of policy holders. Okay, so insurance is nothing but it's just division of risk. Now why does insurance exist, and why do insurance companies exist in the modern world? Why can't we just go with this approach? Well, we could, and I think with the internet, crowdfunding campaigns are also quite possible. So that possibility is you can always create a pool of money amongst your relatives for hard times. You can always create groups of 1,000 or 2,000 people on the internet who can just contribute maybe a small sum of $10 each, and that will create a good pool of money for whoever needs it during trouble. That is entirely possible. But in today's world, the world is really big. There are just too many people in the world, And there are too many people who are facing very similar risks and they don't know each other personally, and there is no way probably that they can connect directly. So they need an intermediary. An insurance company is just simply an intermediary which just connects these people who don't know each other, who face similar risk, and then helps in dividing the risk over a large number of people. That's all an insurance company does. It takes that risk and divides it over a large number of people and charges its commission and profits in the process. So that is the social utility of insurance, and that's why insurance companies exist in the modern time, because it's very difficult for such a large number of people to cooperate. Here it was just 10 farmers in a village, but then there are risks that we face today, risk related to our life, related to our health, related to our maybe theft, maybe our devices have a lot of risk of breaking down. Our automobiles have a lot of risks. So there are a lot of risks in the modern world, and there are a lot of people who face similar risks. So they can easily divide by coordinating through insurance models, right? So that's what insurance companies essentially are. Now that we have established the job of insurance company is to divide risks, right? So basically in this case, what the insurance company would do, if it is charging no profit, it would charge just a premium of 20 rupees from each of the farmer, very simply speaking, and then in case there is a crop failure, they will be paid 80, right? So this is basically the benefit, and this is the premium, except the fact that here the premium is being paid by those people who are not suffering the risk, okay? But then if we can flip this model in such a way that in the beginning of the year all of them contribute a certain amount to begin with in the beginning of the year to cover for any losses that occur at the end of the year, it would become quite like insurance, and that is what happens, right?